The global solar industry is in big trouble. What is considered to be the cheapest form of energy in the form of solar power is now turning out to be a nightmare for the companies that install solar panels, give technologies for solar panels, and buy energy from solar panels. And there's no two companies more popular in the US at least than SolarEdge and Enphase Energy when it comes to taking advantage of the massive boom we've seen in solar energy. Just last night, we learned that SolarEdge is slashing its operating margin guidance for the second quarter by more than 70%, citing significant issues scaling its business in Europe and seeing a lot of inventory building. Solar stocks now for 2023 are on average down more than 45%, demolishing the returns of something like the S&P 500 or the Nasdaq, making it one of the worst performers out of all sort of sectors. So why on earth is supposedly the best way to make renewable energy becoming so problematic for the businesses that run technologies around solar? How do interest rates play into this, and will these businesses be able to recover throughout 2024 if there is some sort of economic relaxation? Well, folks, those questions are exactly what we're going to address in this video. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. To start things off, folks, let's first address why last night and today have been one of the worst times for solar stocks in their short history, with SolarEdge stock down almost 30% and Enphase Energy stock down around 15%. This kind of reaction is typically followed by an earnings report, where typically Wall Street had much higher estimates of what the company was going to produce. But in this case, SolarEdge's business is performing so poorly in the short term that they had to release their earnings ahead of time in a preliminary third quarter results report to make sure Wall Street understood exactly what's going on and to not give any major surprises to investors come earnings day. And well, as you can see, those expectations were clearly a lot higher than what SolarEdge is actually going to end up reporting, of $906 million compared to $720 million as now future estimations from SolarEdge for the last 3 months. According to the CEO of this company, which is based in Israel, this has nothing to do with what's going on in the Middle East. Instead, it has everything to do with what's going on in Europe and not even China or North America. Particularly, he cited the fact that they are witnessing a record amount of unexpected cancellations and pushouts in their inventory channels from their European distributors, which obviously are the companies and businesses that directly communicate to SolarEdge's end users. Where historically SolarEdge expects an increase in installation rates at the end of the summer and going into September, the company is instead witnessing a significant slowdown, which is most likely attributed to the rapid rise in global interest rates. And let's be brutally honest, folks, the two words I just mentioned can really be attributed to the entire destruction in stock market valuation of 99% of companies over the past 2 years. And as it turns out, those rates unfortunately disappropriately affect energy companies, clean energy stocks, and especially those in the solar business. Because, as it turns out, solar is still a little bit expensive for households and businesses because of the lack of ROI in the immediate term. Although the cost of solar modules has fallen to all-time lows over the past decade and made it cheaper to make energy from solar farms than it is from nuclear, coal, or oil, businesses still need to take on loans and upfront capital to be able to implement these onto their rooftops or even residential houses. The average solar panel in the US costs around $15,000, and a lot of households don't have that kind of cash laying around to deploy on this technology that is only going to benefit them returns in 10 to 15 years. That means banks have to lend money out to some of these companies who are willing to invest in solar, and that means they are extremely affected by any sort of rising interest rates. And well, although last year saw a record 40% growth in solar installments across the world, this year is a different story because as interest rates go up, all of a sudden the profits and the margins in this industry get transferred from OEMs, suppliers, and distributors to lenders. And as it turns out, the record low cost of solar photovoltaic cells is not helping these businesses either, as this means not only is more competition coming from cheaper manufacturing sites like Malaysia and China, but overall profit growth opportunities are extremely low, especially because this results in a very lengthy ROI because of the lack of efficiency in solar. This means you need a lot of space to produce a similar amount of power, and that reduces the efficiency of the entire system and lengthens the return on investment for individual users. But because right now solar really is the only viable way to use more sustainable energy, aside from using nuclear or wind, which we all know are very, very expensive to implement, solar really is still going to be a fastly growing industry over the next few decades. And that right there, folks, is something that markets simply can't really price in the short term, as most investors really just care about financials instead of fundamentals. Yes, SolarEdge and Enphase and other companies like First Solar and SunPower are going to struggle this year and next year. And that is exactly why their stocks are down more than 50% on average for 2023. But as many analysts and industry executives have pointed out over the past few months, a lot of the declines we're seeing in the solar industry are not only related to interest rates, which is the big concern amongst Wall Street investors. A lot of it, also particularly in Europe, has to do with the lack of installers as well as the lack of electronics distributors to take on the load and the inventory, which just so happens to be one of the issues that SolarEdge just told us about. The labor shortage truly is no joke, and in the European Union, where cost of gas and living is going up much faster than it is here in North America, this becomes a much bigger problem for companies like SolarEdge. Yes, this year is going to be tough, but interest rates are not going to stay sky high for a very, very extended period of time, and as we all know, the industry is going to adapt to whatever happens in the market. And something like solar is still expected to grow at a rapid rate, even during times of really high interest rates like we saw from 2000 all the way to 2010. Certainly, the solar industry has issues to overcome in the short term, but I don't think this should dismay people away from investing in the clean energy area, which we all know grows alongside investments and not necessarily is directly correlated with interest rates. PEG ratios and forward PE ratios are now below 25 for a stock like Enphase, which in the context of 80% return on equity as well as a 20% profit margin is certainly a really good potential investment deal. Now obviously folks, there's nothing guaranteed when it comes to the investment market, so make sure to do your own research before buying or selling any sort of position. I hope you found some value from this video. Thanks a lot for watching, and I'll catch you guys in the next one. Take care.